Silver just did something that almost no one in mainstream financial media is talking about. In Shanghai, silver surged past $100 per ounce. But in New York, it's still trading in the high $80s. That's not a small fluctuation. That's not normal volatility. That's a serious global price divergence. And here's the part that should get your attention. In just a few days, a key COMEX delivery deadline hits. If physical demand tightens even slightly, this pricing gap could force a reaction. The question isn't whether silver is moving. The question is the global silver pricing system starting to strain under pressure? Let's break this down carefully. When markets reopen after holidays, price volatility is normal. But what happened in Shanghai wasn't just volatility, it was a sharp repricing. Silver traded near $102 per ounce on the Shanghai exchange. Meanwhile, Western spot pricing remained significantly lower. Now, price gaps between global markets can happen, but usually they don't last long. Why? Because arbitrage exists. Silver trades at $100 in one region and $88 in another. Traders typically buy the cheaper market and sell the higher one. That process normally narrows the gap quickly. That's how global commodities are designed to function. So when the spread remains wide, it raises deeper structural questions. Is demand in Asia temporarily overheated? Or something happening beneath the surface? Something involving physical supply? Here's why this matters for us investors. Most Americans follow COMEX pricing. Most ETFs and retirement accounts reference New York futures. Most financial headlines reflect Western spot prices. But if global demand begins pulling physical silver toward Asia at elevated premiums and inventories start tightening, the pricing structure becomes more sensitive. Because in New York, a significant portion of silver trading happens through futures contracts. That means enormous volumes of silver are traded on paper. Contracts change hands, positions roll over. Speculators hedge, but physical bars don't always move. In China, however, settlement tends to lean more heavily toward physical delivery. That difference matters. When a market focused on physical settlement trades meaningfully higher than a market dominated by paper contracts, it suggests tension. Either Asian demand is overheated and temporary, or physical metal is becoming more valuable than paper exposure. And if physical metal starts commanding a premium globally, it can create stress inside leveraged futures structures. Now, let me be clear. This does not mean the system is collapsing tomorrow. It does not guarantee a supply crisis. But it does mean this divergence deserves attention. Because markets don't usually flash this kind of signal without a reason, and timing makes this even more interesting. Comp operates on delivery cycles. As key delivery dates approach, traders holding futures contracts must decide whether to close their position or stand for delivery. If more contracts demand delivery than expected, inventory levels suddenly matter. Recently, registered silver inventories have been trending lower compared to past peaks. Again, not panic, but combine three things: shrinking inventories, high open interest, and a widening global price gap. That combination increases system sensitivity. Markets rarely break when everything looks obvious. They break when imbalances quietly build. Then one trigger exposes them. And right now, silver is flashing a signal most investors aren't watching. To really understand why this price divergence matters, we need to look at how the silver market is actually structured. Because most investors assume when they see a silver price on their screen that represents a simple supply and demand balance. But the reality is more layered than that. The majority of daily silver volume in New York does not involve physical bars changing hands. It involves futures contracts. A futures contract is an agreement to buy or sell silver at a future date. Most of these contracts are never settled with physical metal. They are rolled, closed, or offset before delivery. This creates leverage. At any given time, the total open interest, meaning the number of active silver contracts, can represent a massive amount of silver on paper. But the actual registered silver available for delivery is only a fraction of that. Now, this system works smoothly as long as most participants prefer financial exposure rather than physical metal. As long as traders are satisfied with cash settlement or rolling contracts forward, the structure remains stable. But when confidence shifts, even slightly, behavior changes. If more participants decide they want delivery instead of paper exposure, pressure builds quickly. And this is where the global price divergence becomes relevant. If silver is trading at a meaningful premium in Shanghai, that creates incentive. Large traders notice that. Institutions notice that. If physical silver commands a higher price in Asia, arbitrage flows can begin pulling metal out of Western vaults. That doesn't mean vaults empty overnight, but it means inventory trends matter more. Now think about this carefully. Futures markets rely on the assumption that not everyone will demand delivery at the same time. It's similar to how banking systems operate. Not every depositor withdraws funds simultaneously. The system functions because behavior remains predictable. But when behavior shifts, volatility increases. So the real question isn't whether there is enough silver in the world. The question is whether the available, registered supply inside delivery systems is sufficient if demand patterns change. And right now, we are approaching a delivery window. When a contract month nears first notice day, traders holding those contracts must decide: close it, roll it, or stand for delivery. If open interest remains elevated going into that window, analysts begin watching coverage ratios. Coverage ratio simply compares how many ounces are represented by active contracts versus how many ounces are registered and ready for delivery. Higher ratios mean more paper claims per physical ounce. Again, this does not mean collapse. But higher leverage means higher sensitivity. When leverage is elevated, small shifts in behavior can produce outsized price reactions. Now combine that structural reality with something else happening in the macro environment. Interest rates remain elevated compared to the previous decade. Liquidity is not as loose as it once was. Geopolitical tensions continue, influencing commodity flows. Central banks globally have been increasing precious metal exposure over the past few years, and investor psychology is shifting. During calm periods, investors chase growth assets. During uncertain periods, hard assets gain attention. If global investors begin increasing physical silver allocations, not through ETFs, but through actual metal, the futures structure feels that. Not because there isn't silver, but because the system was built assuming a certain behavioral pattern. And systems become stressed when patterns change. Let's consider a scenario. Delivery demand in an upcoming contract month exceeds expectations, registered inventories decline. While global premiums remain elevated, confidence tightens. If confidence tightens, more participants consider securing physical exposure earlier rather than later. That feedback loop can accelerate price adjustments, not slowly, but quickly. Commodity markets often move in sharp repricing waves rather than gradual shifts. That's what makes moments like this interesting, because price divergences across major global hubs are not common. They tend to appear when demand flows shift faster than the pricing structure adapts. Again, this is not a prediction of an immediate crisis, but it is an observation of structural tension. And markets respond to tension in one of two ways. The gap closes calmly through arbitrage and increased supply flow, or the gap closes through a sharp repricing event. The key is timing. We are entering a window where positioning decisions are being made. Paper contracts will either roll forward quietly, or some will convert into physical claims. And if the percentage that stands for delivery rises even modestly above normal levels, volatility increases. Because futures markets are efficient during stability, they are reactive during stress. And silver, historically, does not move in small, polite increments when pressure builds. It reprices. Suddenly, which brings us to the bigger question. If this divergence continues, and delivery pressure builds, what are the possible outcomes for price? And more importantly, what should disciplined investors be thinking about right now? Now let's move from structure to scenarios, because markets don't move on emotion alone. They move based on positioning, liquidity, and probability. So what are the realistic paths forward from here? Scenario 1 is the calm resolution. In this case, the price divergence between Western futures markets and Asian physical markets narrows gradually. Arbitrage traders step in. Metal flows where it's needed. Delivery demand remains within normal ranges. Open interest declines smoothly into the notice period. In that environment, silver can still rise, but it rises in a controlled, orderly fashion. Volatility remains contained. This is the pressure releases slowly outcome. Scenario 2 is a tightening environment. Delivery demand runs slightly above average. Registered inventories decline modestly. Premiums in Asia stay elevated longer than expected. Nothing breaks but confidence shifts. When confidence shifts, positioning changes. More participants begin securing physical exposure rather than relying purely on paper contracts. That subtle behavioral change increases sensitivity inside the futures structure. And silver historically responds aggressively when positioning becomes crowded on one side. You've seen this before? When silver moves, it doesn't grind higher quietly. It expands. Fast. Scenario 3 is the stress scenario. This is not a collapse narrative. It's a liquidity narrative. If delivery demand surprises to the upside during a high open interest month, and if registered stocks are already tight relative to contract size, and if global physical premiums remain elevated simultaneously, then pricing mechanisms must adjust quickly to restore balance. The futures price would likely rise sharply to discourage further delivery requests and attract additional supply. That kind of move is not gradual, it's reflexive. Price rises gives fear of missing exposure, rises gives more demand, rises gives price accelerates. Silver has historically demonstrated this reflexive characteristic during structural squeezes. Now here's the part most retail investors misunderstand. This is not about running out of silver. There is silver in the world. The issue is pricing and location. Markets clear through price. If metal needs to move from one region to another, price must incentivize that movement. And when price must adjust rapidly to rebalance supply and demand, volatility increases. That's where opportunity and risk both expand. Now let's zoom out to the macro layer. We're in an environment where global debt levels remain historically elevated. Real interest rates fluctuate and influence hard asset demand. Central banks have been steadily accumulating precious metals in recent years. Geopolitical fragmentation is increasing commodity regionalization. Silver sits at the intersection of monetary metal and industrial asset. It responds to inflation expectations. It responds to liquidity cycles. It responds to manufacturing demand. That dual nature makes it uniquely volatile. So what should disciplined investors be thinking about? First, avoid emotional positioning. Parabolic moves can reverse sharply. Second, understand your time horizon. Short-term traders care about delivery windows and open interest. Long-term holders care about structural allocation to hard assets during monetary instability. Third, watch behavior, not headlines. Watch open interest into notice periods. Registered inventory trends, global premium spreads, volatility expansion. These are signals, not social media narratives. And finally, risk management matters. Silver can rise 20% in weeks, can also retrace violently. Leverage magnifies both outcomes. The opportunity is real. But discipline separates strategic investors from reactive traders. Now here's the key takeaway. We are not in a confirmed squeeze. We are not in a confirmed breakdown. We are in a window of structural tension, and structural tension is when markets reprice. The divergence between major global silver hubs is a signal, not noise. The next few delivery cycles will tell us whether this resolves calmly or accelerates. If you want to stay ahead of these structural shifts, not react after the move, you need to monitor positioning before headlines catch up. Because by the time mainstream coverage talks about a silver squeeze, the move is usually already underway. If this breakdown helped clarify what's happening beneath the surface of the silver market, make sure you stay connected. This channel focuses on global macro, structural commodity flows, and financial system signals, not hype. Because in volatile markets, information advantage is everything, and timing is rarely polite.